So excited about a company that they forget the oldest rule in the book. Popularity is not the same as profitability. And recently, I've watched millions of people pile into one stock with a level of confidence that makes me more cautious than optimistic. People tell me, "Warren, Tesla is the future. How can it possibly be risky?" Well, the moment everyone believes a company can't fail is usually the moment when risk quietly becomes the highest. And if you're not careful, you can lose a lot of money without the company ever doing anything wrong. When I was a young man working under Ben Graham, I made many of the mistakes that new investors still make today. I was eager, curious, and overly impressed by the companies that looked exciting from the outside. I paid far more attention to the stories being told than to the actual numbers behind those stories. If a company had a brilliant founder, or if newspapers described it as the future of an industry, I often assumed that meant it was a good investment. If everyone around me seemed convinced that a business was destined to dominate the world, I felt a subtle pressure to believe the same thing. I didn't yet understand that excitement and profitability are two entirely different things. Eventually, after losing money in a few situations that looked promising but had weak fundamentals, I learned a lesson that would stay with me for the rest of my life. A business doesn't become a great investment simply because it's innovative, disruptive, or popular. It becomes a great investment when its underlying economics actually support long-term value creation for shareholders. The automobile industry was one of my earliest teachers. People today see a handful of car companies and assume it's always been that way. But the truth is, the early 1900s in America were like the Wild West of automobile manufacturing. There were more than 2,000 automakers in the United States alone. Every city had someone building cars. Every founder believed their design would change the world. And many of them truly were innovators. They built impressive vehicles, introduced new technologies, and captured the public's imagination. But despite all that, almost none of them survived. Competition was fierce, capital needs were enormous, and even small economic downturns wiped out companies that looked successful just a few years earlier. You can invent a wonderful product, but if your business structure is fragile, if your costs grow faster than your profits, or if 10 other companies can copy what you're doing, the odds of long-term success become painfully small. When I studied the history of that era, I noticed something important. Most of the early winners weren't actually winners in the long run. Some of the companies that dominated the market in the 1,910 seconds and 1,920 seconds disappeared entirely by the 1,930 seconds or 1,940 seconds. Names that once filled the newspapers became footnotes in history. Investors who bet heavily on the next big car company often lost everything, not because the idea was bad, but because the economics couldn't support the enthusiasm surrounding it. That pattern has repeated itself in many industries over the decades. Innovation crée excitement, but economics determines survival. And that history shapes how I view Tesla today. It's undeniable that Tesla has pushed the automotive industry forward. It's undeniable that they've been a catalyst in the shift toward electric vehicles. But experience has taught me to separate admiration for a company's achievements from the cold, hard calculation of whether the business can consistently produce durable returns. I don't judge Tesla by its popularity or by the headlines surrounding it. I judge it through the same lens that the automobile industry taught me long ago. Does the long-term economic reality justify the optimism? Because if history has shown us anything, it's that even groundbreaking industries can leave their early leaders behind, and being first is no guarantee of being the last one standing. Tesla is, without question, a remarkable company in many respects. It has forced an entire century-old industry to rethink how cars should be built, powered, and sold. That is no small achievement. But when you invest, you must separate admiration from analysis. The two are not the same thing. You can admire a company's innovation, leadership, and contribution to society, but the moment you write a check to buy its stock, you are stepping into the world of numbers, not feelings. And numbers have a way of cutting through excitement with cold precision. Whenever a company reaches a very high valuation, I always ask myself the same basic question: how much money will this business realistically produce over the next decade or two? not how many headlines it will generate, not how many fans it has, not how exciting its products look, but how much real cash is going to end up in the pockets of the owners, the shareholders, year after year. Because when you buy a stock, that's what you're actually buying, a claim on future earnings. Now, let's put Tesla's valuation into perspective using simple, easy to understand reasoning. At various points, the company has been valued at more than $1 trillion. To justify that price in the long run, Tesla would need to produce extraordinary amounts of profit consistently year after year. Let's say, for the sake of argument, that Tesla eventually earns $50 billion in net profit annually. That would make it one of the most profitable companies in the world, on par with the giants of technology and energy. It would be an extraordinary accomplishment for any business, especially an automaker. But even if that happens, and it's a big if, an investor paying something like $800 billion to $1 trillion for the company is still paying a very rich price relative to those potential earnings. At those numbers, you're essentially paying 16 to 20 times earnings for a mature company in a fiercely competitive, capital-intensive industry. Most great businesses I've invested in over the decades didn't require that level of perfection to deliver good returns. They simply had strong, predictable economics and were bought at sensible prices. The nature of the automobile business makes high long-term returns difficult. Unlike software companies, which can sell an extra unit at almost no additional cost, automakers must spend enormous amounts of money to grow. Every factory requires billions of dollars. Every new model requires years of research, testing, and manufacturing adjustments. Labor, materials, regulatory requirements, distribution networks, all of these take continuous capital. That means even when sales go up, profits don't always follow at the same pace. When you buy a business, you want what we call high return on invested capital. You want each additional dollar the company reinvests to generate several more dollars in earnings. But automaking rarely works that way. Historically, it's been an industry where companies need to reinvest constantly just to stay in the game, not necessarily to achieve extraordinary profits. Investors often overlook that reality. Tesla has made tremendous progress, but the math doesn't change simply because the company is innovative. The question you must always ask is, do the long-term economics justify the price I'm paying today? If the answer requires flawless execution, continued dominance, and no major competitive or regulatory disruptions, then you are relying on hope, not fundamentals. Investing based on hope is not investing, it's speculation. And that is why, when I analyze Tesla, I focus less on the excitement surrounding the company and more on the durable financial logic behind it. Because in the long run, the value of a business always ties back to the cash it can generate, not the stories, not the headlines, not the hype. The numbers eventually tell the truth, even if the market takes a long time to notice. Whenever I see investors become overly optimistic about a fast-moving industry, I remind myself of something that is repeated throughout economic history. The early excitement almost always hides the long-term risks. And in my lifetime, I've seen that pattern play out in one industry after another. You get an innovation that captures the public's imagination. You get a few early winners who look unstoppable, and suddenly everyone is convinced that this time the story is different. But if you zoom out and study the numbers, you'll notice that the economics usually bring every company, no matter how exciting, back down to earth. The automobile industry is a perfect example of this. Over the last century, it has been one of the most transformative industries in the world. It reshaped cities, changed how people lived and worked, and became deeply embedded in everyday life. But despite all that importance, the industry has been one of the worst places for investors to make money consistently. Low margins, high competition, constant reinvestment, and the need to keep up with new technologies made it extremely difficult for any company to produce strong, reliable returns decade after decade. When people today get excited about Tesla, I understand why. It's innovative, it's fast-growing, and it represents the future in many ways. But I also know that the auto industry has a long history of punishing even the most promising companies. If innovation alone guaranteed success, the early giants of the 1,920 seconds would still be household names today, but they're not. Most of them vanished because the economics of the industry were unforgiving. That brings me to another point. Competition doesn't sit still. When one company discovers a breakthrough, the rest of the industry studies it, copies it, and often improves on it. Right now, almost every major automaker in the world, from Europe to China to the United States, is investing heavily in electric vehicles. These are companies with deep pockets, global manufacturing networks, and decades of experience operating in tight margin environments. Once they catch up technologically, the competitive environment becomes brutal. Prices fall, profits shrink, and the growth story changes very quickly. Investors often fail to price in how rapidly a competitive advantage can evaporate in a field where everyone is racing to catch up. There's another layer of risk that doesn't get enough attention: government policy. Electric vehicle adoption depends heavily on subsidies, regulations, and political priorities. I've lived long enough to see policies change overnight. Sometimes they shift because of economic pressures, sometimes because of elections, and sometimes simply because governments miscalculated the long-term cost. When incentives disappear, demand can weaken. When regulations tighten, costs rise. And when governments decide to favor local manufacturers, foreign companies suddenly find themselves at a disadvantage. An investment that relies on political predictability is always on shaky ground. And then there is speculation, the most dangerous force in markets. Once a stock becomes part of a cultural movement, it no longer trades on business fundamentals. It trades on emotion. People buy it because their friends own it, because social media praises it, or because they fear missing the next big thing. Emotion-driven markets can climb very high very fast, but when the mood changes, and it always does, the decline can be brutal. I've seen this more times than I can count. The Nifty 50 in the 1,970 seconds were considered untouchable. Many of those companies later dropped 70 or 80%. In the dot-com era, people said profits no longer mattered. That didn't end well. More recently, we saw cryptocurrencies soar and collapse within a matter of months. The pattern never changes because human nature never changes. So when I talk about the risks surrounding Tesla, I'm not criticizing the company itself. I'm pointing out the structural risks of the industry, the competitive pressures that will only intensify, the regulatory uncertainties that could shift at any moment, and the speculative behavior that has driven prices far beyond what the underlying economics justify. Investors should not ignore these realities. If you're investing based on enthusiasm alone, you are stepping into a field that has humbled far more people than it has enriched. And when you combine a risky industry with a speculative market, history tells us the result is rarely pleasant for shareholders who bought at the top. That's why caution is essential. It's not about being pessimistic. It's about recognizing that risk is far easier to overlook than reward is to achieve. And the market, sooner or later, always returns to rationality, even if it takes longer than anyone expects. Now, I want to make something very clear. I don't say any of this because I dislike Tesla or because I underestimate what the company has accomplished. In fact, I admire innovation. I admire leaders who push an entire industry forward. And I admire companies that attempt difficult things when most others choose the safer path. But admiration is not the same as investment. I've learned over the course of my life that the stock market rewards discipline, not excitement. It rewards patience, not speed. And it rewards clear thinking far more than it rewards bold predictions. When I look back at the investments that produced the best results for Berkshire, they all shared a few characteristics. They were simple to understand. Their businesses were stable and predictable. Their products or services were essential in everyday life. And they had a moat, a durable competitive advantage that protected them from rivals. Just as importantly, we bought them at prices that made sense. We didn't need perfection from them. We didn't need extraordinary technological breakthroughs. We just needed them to keep doing what they already did well. And that's the piece of wisdom that many investors forget when they chase fast-growing companies. A wonderful business does not automatically make a wonderful investment if you pay too high a price for it. The price you pay determines the return you get. If you overpay, even for something excellent, your returns will suffer. It's like buying a great farm at 10 times the value of its crops. The farm may be wonderful, but your investment won't be. Investors often fall in love with stories. They want the next Amazon, the next Apple, the next Google. But the funny thing is, the people who made the most money on those companies didn't buy them because they were exciting. They bought them because, at the time, the price was sensible relative to the opportunities ahead. Excitement came later. Profits came from discipline, not enthusiasm. In my view, the best investment decisions happen when you strip away all the noise, news, predictions, market chatter, and focus on two simple questions. Is this business going to be meaningfully bigger and more profitable 10 years from now? And is the current price reasonable compared to that future? If you cannot answer both questions with confidence, you should be careful. And if you need the company to grow at extraordinary, near-perfect rates to justify today's valuation, then you're leaning on hope, not analysis. Tesla has achieved impressive things, but an investor must ask whether those achievements translate into durable shareholder value. Will the company maintain a wide moat as competitors flood the market? Will margins stay strong as prices fall and new EV makers emerge globally? Will regulatory environments remain favorable? Will the capital intensity of the business allow for steady, predictable returns? These aren't emotional questions. They are simply the kind of logical considerations that long-term investors must think about before committing capital. And this is where investment philosophy matters most. Over the years, I've resisted thousands of opportunities because they didn't meet the test of long-term predictability. Many of those companies looked exciting at the time. Some of them captured headlines. Some experienced huge short-term gains. But if the underlying economics weren't solid and predictable, I had no interest. I never felt bad about missing out on something I didn't understand or something that didn't meet my standards. There will always be another opportunity. The truth is, investing is not a game of speed. You don't score extra points for acting quickly. You score points by making sound decisions that compound over long periods. It's far more important to avoid mistakes than to chase brilliance. Most investors underestimate how powerful patience is. If you simply wait for the right business at the right price, your results will take care of themselves. So when I talk about companies like Tesla, my message is the same message I tell young investors everywhere. Don't get swept up by the excitement of the moment. Focus on the fundamentals. Look for businesses with durable economics, wide moats, strong cash flows, and sensible valuations. And be patient enough to wait for the right moment. Investing is not about predicting the future. It's about preparing for it with discipline, rationality, and a willingness to say no far more often than you say yes. In the end, that approach has served me well for a lifetime, and I believe it will serve you well too. As I grow older, I find myself appreciating the lessons that time teaches far more than the lessons any market cycle can provide. When you've been investing for as long as I have, you begin to understand that the real secret to success isn't brilliance or quick decision-making. It's the ability to avoid the big mistakes. People often assume that successful investors spend their time hunting for the next breakthrough company, the next big winner, the next stock that will double or triple. But if you ask me what has contributed most to Berkshire's long-term results, I'd give you a very simple answer. We avoided the disasters. Avoiding the big losses is far more important than chasing the big gains. Most people don't realize how destructive a large loss can be. If you lose half your money, you don't need a 50% return to recover. You need a 100% return just to get back to where you started. That math isn't emotional, it's just arithmetic. And arithmetic has a way of humbling investors who take risks they don't fully understand. That's why I've always approached investing with a focus on minimizing permanent loss of capital. Growth is wonderful, but protection is essential. Experience has shaped this mindset. I've lived through nearly every kind of financial environment you can imagine. I've seen periods of euphoric optimism and moments of deep panic. I've watched the market soar to heights people said were impossible, and I watched it collapse in ways people claimed would never happen again. I've seen wars, recessions, political turmoil, inflation spikes, oil shocks, financial crises, technological revolutions, and more recently, entire industries disrupted by new inventions. Throughout all those decades, one principle has stayed constant. The businesses that endure are the ones built on solid fundamentals, not excitement. And the investors who endure are the ones who keep their feet on the ground when everyone else is floating in the clouds. When I look at younger investors today, I often see a great deal of pressure to act quickly, to keep up with trends, to buy what everyone else is buying. Social media, constant news alerts, and endless market commentary create the illusion that you must always be doing something. But investing doesn't reward motion. It rewards judgment. And judgment comes from understanding your own limitations. I've never been in a hurry to invest in something just because the world seemed excited about it. In fact, some of the best decisions of my life were the decisions not to act. Saying no is one of the most powerful tools an investor has. It keeps you disciplined, it keeps you rational, and it gives you the freedom to wait for the rare opportunities when the stars align. A great business, a durable moat, and a sensible price. You don't need to invest in everything. You don't need a portfolio of 50 ideas. You need a few good ones, patiently chosen and patiently held. People sometimes ask me why I didn't invest in certain companies that later became giants. And my answer is always the same. If I don't understand the long-term economics, or if I can't predict the business 10 years down the road with a reasonable degree of confidence, I simply pass. Missing out on an opportunity is far less painful than losing money because you convinced yourself you had to be part of something exciting. There's nothing wrong with watching a company from the sidelines. You don't need to be on every train that leaves the station. And that perspective shapes how I evaluate companies like Tesla or any other fast-moving, rapidly evolving business. I don't need to predict whether it will succeed or fail. I don't need to be part of the excitement. What I need is clarity. And clarity comes from looking at a company the same way I look at any business, through the lens of long-term economics, competitive durability, and the price being asked of me today. After a lifetime of investing, I've learned that your best results often come not from boldness, but from restraint, from the ability to remain calm when the world is emotional, from the willingness to stay patient when others are impatient, from the discipline to focus on fundamentals when the crowd is chasing stories. That is the legacy of everything I've experienced. The understanding that success in investing isn't determined by how many times you swing the bat, but by how selective you are with your swings and how well you protect yourself from the pitches you shouldn't be swinging at in the first place. At the end of the day, my message about Tesla or any high-profile company is not meant to discourage you from investing. It's meant to encourage you to think clearly before you invest. There is a difference, and it's an important one. Tesla may very well play a major role in the future of transportation and energy. It may innovate in ways the world hasn't fully appreciated yet, and it may become even more successful than people expect. But none of that changes the responsibility you have as an investor to make decisions based on facts, not forecasts, on economics, not emotions, on discipline, not desire. The key lesson I've learned after a lifetime in this business is that the stock market will test your temperament far more than your intelligence. It will tempt you with excitement. It will pressure you with fear. It will present you with opportunities that look irresistible and risks that don't appear dangerous until it's too late. Through all of that, the only thing that keeps you grounded is a commitment to timeless principles. Principles such as buying with a margin of safety, evaluating businesses based on sustainable economics, and thinking in decades rather than days. When enthusiasm rises faster than earnings, caution becomes your strongest ally. When the crowd is certain that a company can do no wrong, that is often the moment when careful analysis is most important. Markets have a long history of teaching painful lessons to those who chase stories rather than studying balance sheets. And the stories always sound convincing at the time. They always sound like something new, something revolutionary, something that breaks the old rules. But old rules survive for a reason. They reflect human nature, and human nature hasn't changed in 100 years of market history. You don't have to predict the future to be a successful investor. You simply have to position yourself so that you benefit when the future is reasonable and survive when the future is unpredictable. If you buy stable businesses at sensible prices and hold them patiently, time will work in your favor. If you stretch for excitement, for perfection, or for the promise of extraordinary growth, time may not treat you as kindly. So when you evaluate a company like Tesla, don't let the headlines decide for you. Don't let the crowd's energy substitute for your own judgment. Take a step back. Look at the long-term economics. Consider the risks, the competitive pressures, the capital requirements, the regulatory landscape, and the price being asked of you. Then ask yourself, will this still make sense to me 20 years from now? If the answer is yes, you may have found a sound investment. If the answer is anything less than a firm yes, you are better off waiting. The market rewards patience far more than it rewards boldness. In the long run, the winners in investing are not the people who make the most predictions. They are the people who make the fewest mistakes. They avoid the illusions of easy riches. They protect their capital. They let compounding do the heavy lifting. And they stay true to simple principles that outlast every trend, every craze, and every cycle. My advice to you, the same advice I would give to my own family, is this: think independently, act rationally, and never forget that investing is a long journey, not a sprint. Opportunities will come and go, but your discipline, your patience, and your ability to say no will stay with you forever. Let those qualities guide your decisions. If you do that, you won't need luck or excitement to succeed. You'll simply let time, even with all its ups and downs, steadily build your wealth. And that, in the end, is the real advantage of investing with a clear mind and a steady hand. It may not be glamorous, it may not be headline-worthy, but it works. And it has worked for me for more than 70 years. If you stay grounded in those principles, it will work for you too. In closing, I want to leave you with something simple, something I've carried with me through every market cycle, every period of excitement, every moment when the crowd seemed absolutely sure that this time was different. The laws of investing do not change just because the world becomes enthusiastic about a particular company. They do not bend for innovation. They do not break for technology. And they certainly don't disappear simply because a business captures the public's imagination. What has guided me for a lifetime, and what I hope guides you, is the understanding that rational analysis will always outperform emotional decision-making in the long run. Tesla may succeed wonderfully. It may shape industries far beyond automobiles. It may continue to innovate in ways that none of us fully appreciate today. But admiration is not a substitute for valuation, and innovation is not a substitute for earnings. As investors, our job is not to cheer for companies. Our job is to carefully evaluate whether the numbers support the narrative. And if they do, at a price that offers a margin of safety, then you have an opportunity worth considering. If they don't, then you have a risk that may be far larger than it appears. Remember that the market is not a voting machine in the short term. It is a weighing machine in the long term. Eventually, every company, no matter how exciting, must be weighed by its actual performance, its cash flows, its competitive durability, and its ability to generate sustainable value for its owners. And when that weighing happens, enthusiasm won't matter. Headlines won't matter. Trends won't matter. Only the economics will matter. If you take anything from this discussion, let it be this: protect your capital by staying rational when others become emotional. Be willing to admire a company without feeling pressured to own it. Be patient enough to wait for opportunities that clearly make sense. And have the humility to accept that you don't need to invest in everything that looks exciting. The world will keep producing new ideas, new technologies, and new businesses. Your job is simply to choose the ones that fit your principles and let the rest pass by without regret. Over a lifetime, that approach has served me far better than chasing predictions or trying to be the first to every new trend. It allowed me to build wealth steadily, safely, and sensibly. And if you follow the same path, thinking independently, valuing rationally, and investing only when the odds are firmly in your favor, you'll give yourself the best chance of achieving financial success without unnecessary risk. In the end, investing isn't about being right in the moment, it's about being right over time. And time, more than anything else, rewards those who stay disciplined, patient, and grounded in principles that never go out of style.